In this video, we will be looking at some questions raised by teachers. Preference share dividend, IAS 32. Note, students are not expected to know the full provisions of IAS 32 that deal with financial instruments. According to IAS 32, redeemable preference shares are under non-current liabilities, and irredeemable preference shares are part of equity. Therefore, dividends on irredeemable preference shares should be shown in the statement of changes in equity, and dividends on redeemable preference shares should be shown as finance costs. Thus, for the sake of consistency, the following policy is to be followed. First, if the question indicates that the preference shares are redeemable, they will be shown as a non-current liability. However, if the preference shares are stated as being non-redeemable, they will be shown as part of the capital of the company and therefore listed under the equity section in the statement of financial position if presenting under IAS. If redeemable preference shares are redeemable within the next 12 months, they should be shown as a current liability in the statement of financial position. Any dividend payable on non-redeemable preference shares, whether paid or not, should be accounted for under dividends in the statement of changes in equity. Note, unpaid dividend is also included in the statement of changes in equity, as unlike unpaid ordinary share dividend that are shown as a note, unpaid irredeemable preference share dividend do not have to be approved of or voted on at an AGM. Third, any dividends paid on redeemable preference shares must also be shown under finance costs in the statement of comprehensive income. Any dividends due on preference shares, redeemable or otherwise, should be accounted for in full in the year. This means that any dividend unpaid at the end of the year should be accrued and the accrual shown in current liabilities. We will now look at paid and proposed ordinary share dividends. Let's look at the following example. A company's year-end is 31st December. The following shows ordinary share dividends paid and proposed by it. Proposed final dividend for the year ended 31st December 2009, payable in June 2010, is $50,000. Interim dividend for the year ended 31st December 2010, payable by October 2010, was $100,000. Proposed final dividend for the year ended 31st December 2010, payable in June 2011, was $130,000. Question 1. Which figure will be shown as dividends in the note to the accounts for the year ended 31st December 2011? The answer is $130,000, as this dividend is proposed dividend and will only be paid after approval from the shareholders at the AGM or annual general meeting. Question 2. Which figure will be shown as dividends in the statement of changes in equity as at 31st December 2011? The answer is $150,000, which is $50,000 proposed dividend for the previous year payable in this financial year, and $100,000 interim dividend for the year ended 2010 but payable by October 2010, before the end of the financial year. Note, this is an example of changes occurring as a result of IAS 1 and the impact of dividends paid and payable. Under IAS 1, only dividends actually paid in the accounting year are included in the financial statements for the year. It does not matter to which year they relate. They can be interim dividends paid in the current financial year or the final dividend in respect of the previous financial year payable in the current year. Any proposed dividends are ignored under IAS 1 and shown in the accounts by way of a note. This is an important change, which effectively means that ordinary dividends are treated on a cash basis rather than an accruals basis. We will now look at paid and proposed dividends of ordinary shares and preference shares. Let us look at the following example. The equity of a limited company is as follows. Pause the video and study the information given carefully. Note, as the face value of each ordinary share is 50 cents, there are 800,000 ordinary shares. Question: what were the retained earnings at 31st December 2013? Solution: profit available is equal to $4,000 retained earnings at the start of this financial year plus $300,000 profit for the year, which is equal to $304,000. Ordinary dividend paid is equal to 800,000 times 20 cents, which is equal to $160,000. Preference dividends is equal to 200,000 times 7%, which is equal to $14,000. Note, even though only half-year dividends were paid off the preference shares, a full year's dividends should be deducted as per the matching principle. Retained profits at the end was therefore $130,000. Let us now examine the differences between provisions, liabilities, and contingent liabilities. According to IAS 37.10, a provision is a liability of uncertain timing or amount. A liability is a present obligation as a result of past events or a settlement that is expected to result in an outflow of resources or payment. A contingent liability is a possible obligation depending on whether some uncertain future event occurs or a present obligation, but payment is not probable or the amount cannot be measured reliably. Let us look at a tricky example based on the creditor's payment period. Pause the video to study the information given carefully. Remember, the formula for creditor's payment period is equal to creditors divided by credit purchases times, in this case, 360. Solution. Let us look at working 1 and substitute the figures given in the formula for creditor's payment period. 30 days is the creditor's payment period, is equal to 80,000, which is creditors, divided by credit purchases times 360, to give us last year's credit purchases of $960,000. Therefore, this year's credit purchases is equal to 960,000 times 1.50, as there is an increase in credit purchases of 50%, to give us $1,440,000. To calculate creditors for this year, let us look at working 2 and substitute figures given. 60 is the creditors payment period now, is equal to creditors, which is not given, divided by 1,440,000 times 360 to give us this year's creditors of $240,000. Let us look at an interesting example that tests one's knowledge of the prudence principle versus the matching principle. Pause the video and study the information given carefully. Question: what will be the charge for interest shown in the company's income statement in each of the 5 years? Solution: the total interest for 5 years is equal to 10% of 1 million times 2 years plus 12% of 1 million times 3 years, which is equal to $560,000. Therefore, the annual interest is equal to $560,000 divided by 5, which is equal to $112,000. Note, the prudence principle or concept is applied here because the same amount of interest is charged each year so as not to overstate or understate the profit. This is an interesting example on marginal costing taken from a past paper. Pause the video and study the information given carefully. Question: how many units will be needed to be sold next year in order to achieve the same profit as in the current year? Solution: the required profit is $140,000. The new fixed costs as per working 1. Fixed cost before increase is equal to 2,000 units times $80 to give us $160,000. Fixed cost after the increase of 10% is equal to 160,000 times 1.10 to give us $176,000. The new contribution per unit is equal to 315 minus 150 to give us $165. The required sales is therefore $316,000 divided by 165 to give us 1,916 units rounded off. This is an interesting example taken from a past paper. Based on net assets after the issue of ordinary shares at a premium and debentures. A company issues for cash 50,000 shares of $5 each at a premium of $15 and 4% debentures for $300,000 cash. By what amount will the net assets of the company increase? Solution: remember, net assets is equal to total assets minus total liabilities. Issuing debentures increases the total assets by way of cash as well as total liabilities, as debentures are considered to be long-term liabilities. Hence, there is no change to net assets. However, issuing shares for cash increases total assets by way of cash with no effect on total liabilities. Hence, in this case, the net assets will increase by $5 face value plus $15 premium times 50,000 shares issued to give us an increase in net assets of $1 million due to the receipt of cash. We will now consider the legal title of goods and when it passes. Even if an invoice says that the legal title does not pass until payment is made, for accounting purposes we assume that the legal title has passed when an invoice has been received by the purchaser along with the goods. What is the reason? In most cases, an invoice will say that legal title of the goods does not pass until payment has been made. It is a standard clause. Theoretically, it means that if payment isn't made, the seller can come to the company and claim back the goods. In practice, this is difficult. Suppose the goods was flour and the buyer has used it to make cookies, or a builder has used cement that he purchased to build a wall. A legal case in the UK decided that to be able to claim the goods, the seller had to be able to identify the exact goods which were the subject of the invoice. This is difficult to do, as illustrated in the two cases above, that of flour and cement. Also, accounts are prepared on an ongoing basis, where an assumption is made that the business will continue to trade. They are also prepared on an accrual basis, so any known liabilities are taken into account. Therefore, a business will include the invoice whether it has been paid for or not. Of course, this applies if the goods are sold in the normal course of trade, not on a sale or return basis. Here is an interesting example on fixed and variable costs, that is in marginal costing, as per a past paper. A company manufactures two products, X and Y. Pause the video and study the information given carefully. Question: how many units of product X must be sold to break even? Solution: the fixed cost of 3,000 units of Y sold and recovered is equal to 3,000 times $30 selling price minus the variable cost of $20 direct labor and $2 materials to give us $24,000. Hence, the fixed cost to now be recovered from the sale of X is equal to $54,000, which is the total fixed costs, minus $24,000, the fixed costs already recovered from the sale of Y, to give us $30,000. Therefore, the break-even point is equal to fixed costs, $30,000, divided by $20 selling price of product X, minus the variable costs of product X, $10 direct labor, $4 direct materials, to give us 5,000 units. Here is an interesting fact while on the topic of marginal costing and absorption costing. Did you know if inventory decreases during a period, the profits under absorption costing will be lower than those under marginal costing? This is an interesting example adapted from a past paper regarding journal entries to be passed for the issue of various types of ordinary shares. Pause the video and study the information given carefully. Let us now look at the journal entries for the issue of shares on the 1st of Jan. There was an issue of 80,000 ordinary shares at 1.25 each. Let us look at the working. January 1st. Amount received would be 80,000 times 1.25 to give us $100,000. Therefore, in the journal entry on the 1st of Jan, bank will be debited $100,000. Going back to the working, the face value of the shares issued would be $1 times 80,000 to give us $80,000. Therefore, in the journal entry, share capital will be credited $80,000. Going back to the working, on the 1st of Jan, the premium was 25 cents per share. Therefore, the total premium received would be 25 cents times 80,000 to give us $20,000. Therefore, in the journal entry, the share premium account will be credited $20,000. Let us now move on to the 30th of June. There was a rights issue of 3 ordinary shares for every 8 shares held on this date at an issue price of 1.30. This was fully subscribed. Let us look at the working. June 30th. Shares issued would be 3 divided by 8 times 400,000 shares that we started with, plus 80,000 shares issued on the 1st of Jan to give us 180,000 shares. The amount received would therefore be 180,000 times 1.30 to give us $234,000. Looking at the journal entry on the 30th of June, bank will be debited $234,000. Going back to the working, the face value of the shares issued would be $1 times 180,000 to give us $180,000. Going back to the journal entry, share capital will be credited $180,000. In the working, to calculate the share premium received on the 30th of June, we will multiply 180,000 times 30 cents to give us $54,000. Therefore, in the journal entry on the 30th of June, the share premium account will be credited $54,000. Let us now briefly look at the balance on the share premium account after the 2 issues. We started out with $20,000 balance plus $20,000 share premium received on the 1st of Jan, $54,000 share premium received on the 30th of June. Therefore, the total on the share premium account is now $94,000. On the 30th of September, a bonus issue of 1 ordinary share for every 6 shares held on this date was made. Let us look at the working. The shares issued would be 1/6 of 400,000 that we started out with, 80,000 issued on the 1st of Jan, 180,000 issued on the 30th of June to give us 110,000 shares. Let us look at the journal entry. The share premium account will be used in the issue of bonus shares. The balance on the share premium account was $94,000. We will therefore debit the share premium account $94,000. The remaining $16,000 will be taken out of retained earnings. Therefore, retained earnings will be debited $16,000 and share capital will be credited $110,000. Remember, the most inflexible reserves are used, that is, the capital reserves are used before the revenue reserves. Therefore, all of the share premium account is used first and then retained earnings. Let us now look at the effect on total equity. Total equity brought forward was $610,000. Added to that, there was a share issue of $100,000 plus a rights issue of $234,000 to give us a total equity of $944,000. The uses of a share premium account. A share premium account can be used for an issue of bonus shares, as in the previous example, to pay the premium on the redemption of debentures, to write off company formation expenses, or to write off expenses of a share issue or a debenture issue. Let us now look at the reasons for issuing bonus shares. They are to release reserves to shareholders with no impact on the cash flow, to liquidate capital reserves that cannot be used to pay dividends, to match long-term assets with long-term capital, and to give a positive signal to potential investors. More information about AS Accounting, a Study Guide. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. The content of this book matches the latest COE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the COE AS accounting course. Some salient features of the book are: it unpacks the COE AS accounting syllabus, IAS terminology has been used, students love the unique question and answer presentation of theory, there are numerous tips for success, and exhaustive exercises for practice. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.